Hey there, Jeff Lewis here from Epic Trust Investment Advisors. Just wanted to give you another quick update on how things are going in the market right now and what we're seeing. This week's been a really big week with the Fed and a few other things going on in our international markets, and it's been quite a ride we're experiencing. And so we're getting a little bit of feedback from some of the folks we're working with, letting us know that they're pretty nervous about what's going on in the market, and they're concerned with where we are and how far we've dropped from our highs back in September. And so I just wanted to put this this video out for you guys, and hopefully this can help with where we are and put some things into perspective about what we should be expecting between now and the end of the year, as well as now and the next 6 months or so. With that, we'll go ahead and get started. I'm going to start sharing my screen and hope you guys enjoy it. So this is our stock market update for December 20th, 2018. We're going to cover really quick an update on the traffic lights and version 2.0 and the improvements we've made to that system and the way that we look at managing money. Also a review of our prior corrections and what makes them different or the same as today's market environment and what we're experiencing today that has so many people concerned. We're also going to do a quick comparison specifically of how the S&P 500 and how it acted in 2011 with its 22% drop and how similar that is to today's market environment that we're seeing. And then we'll do some quick takeaways. So as a quick refresher for the traffic light system and how it works is that we're looking at the overall market, and the basic premise of the traffic light trading system or the traffic light models that we're looking at is that we really want to be following trends. Are we going in an uptrend? Or we're going in a downtrend? And we're really looking at longer term trends over several months at a time, not several days or several weeks, but we want several months at a time. And so what we're trying to accomplish is just trying to be on the right side of that trend. So as you can see here, like in 2003 to 2008, we want to be on this upside of the trend, but we want to be able to avoid this downtrend. And so we use a couple of technical indicators to help us do that. I'm not going to go into a really depth explanation of how the traffic light system works and what it is we're looking for, but just from a basic understanding, just remember that all we're trying to do is be on the right side of the trend. So if the trend is up, we want to be invested. If the long-term trend is down, like in 2008, or in the tech bust of 2000 to 2003, we want to avoid those time frames if we can. And so the traffic lights, using a couple technical indicators, help us to do that. And so what we're looking at here is there's this big downtrend that we want to avoid, the next big downtrend. These are the things we're looking for to try and stay away from with the money that we're investing on behalf of our clients, because this is their life savings and this is your life savings. You can't afford to lose 50% of your money again when you're in retirement or when you're getting close to retirement. And so most of the folks that work with us are in that age range, and that's one of the big concerns that they're concerned about. So we have to manage money with that in mind, and that's why we use the system that we do. So that's the positive scenario, and the reality is that the traffic light system, the way that it's designed, it is going to help us avoid these really long drawdown periods where we lose 30 or 40 or 50% of a client's portfolio or your money. You're not likely to see that happen using the traffic light system. However, there's good and bad, right? There's no such thing as a system that works all the time. And so one of the downsides to using the traffic light is that we get these false warnings in here where the traffic lights show that we might have a signal here, and we end up missing out on some of the upside that the market could produce for us. And so one of the things that we're doing with the 2.0 update, and one of the things, reasons that I'm telling you about this right now in this video, is to let you know why we haven't actually triggered the traffic light for today, right now in our market environment, even though historically we would say that we have triggered. But we're going to go through why we haven't actually taken action and moved money out of the market yet, specifically because we genuinely feel that this upgrade to the system and staying invested in the market is actually the better thing to do with your money, even though it's painful to go through, because in the long run you actually make more by doing so. But we really do need to avoid these big green circle drawdown periods, and if we can avoid those, you keep your money and you're happy as an investor. So let's go into one of the big triggers that we've changed. Instead of transitioning on each one of these signals that we end up seeing where we cross that red line, we're only transitioning after we experience a sell signal from an inverted yield curve as well as several other economic indicators. Specifically, this is the one I went over in the last video that I put out there a few weeks ago. But when we see an inverted yield curve, it has been the best predictor of an economic recession for the last 5 recessions since the 80s. And so that's one of the things we're looking at, as well as several other economic indicators. This isn't the only thing, but it's the one I wanted to talk about today because it's a refresher from last video that we did. So when we experience a sell signal like the inverted yield curve, as well as other economic indicators, that's when we actually are going to end up triggering the traffic light so that we move money out of the market. Otherwise, we're going to keep invested, we're going to stay invested, we're going to look for opportunities to buy while the market's down and while it's on sale, and we're going to stay through these smaller, shorter-term market corrections. So let's go into some of those. I'm going to compare the last 2 major recessions to the last 5 or 6 small corrections that we've had. And they haven't necessarily been small, they've just been short-lived. So when I say small, I mean small in time frame, not necessarily in magnitude. So this screen here is the S&P 500, and what we're seeing right now is from the year 2000 to the year 2007, almost 2008. In April of the year 2000, that was our peak month in the S&P 500. What we experienced during that time frame is over 37 months, we experienced over a 50% drawdown in the S&P 500. That means if you had $100,000, 37 months later, April of 2003, you would have had $50,000. And then we would be climbing back out of that, which means you have to have a 100% return to be able to get your money back and recover from a 50% loss. Because if our money goes from 100,000 to 50,000, we need to gain 50,000 to get back to our 100, and that's why it takes so long. It took over 43 months to be able to recover from that 50% loss and get that return back to just breaking even. Now, as soon as we broke even, here we are at the end of 2007. This is the beginning of this next chart where the next market correction hits, and this is the financial crisis of 2008. This one was much shorter in time frame, but it was just as strong in magnitude. This only lasted 18 months, but it was preceded by an inverted yield curve as well as several other economic factors that showed that the economy was slowing and we actually entered an economic recession. And because of that, those recessions are the real defining factor between whether or not we want to move money in or out of the portfolio, or we just want to ride through the market correction. So right now we're looking at the S&P 500 from 2008 through 2013, almost 2014. And what we're seeing is that in 18 months, we saw a total of a 57% drawdown from its best day to its worst day, and it took 48 months again to recover. And I want you to start seeing this pattern here. There is a pattern, and we want to follow that pattern. And it doesn't always speak exactly the same language, but it's almost always rhyming. And that's what we're going to see in these next couple of charts. So this next chart I widened out from 2009 to 2018. So I took a 10, 11-year stretch, and I want you to see what all these smaller corrections are doing in that time frame. So let's go with the next several. I'm going to try and speed this up a little bit. We've got April 2010 to July 2010. It was 3 months worth of a drawdown, but we lost over 17% of the S&P 500 in just 3 months. That's a really strong move. And just so you know, that's pretty close to what we've experienced today with the Fed's announcements yesterday. So we lost 17% in 3 months, but it only took 4 months to recover. So that was a pretty short-lived correction and recovery. And had we been following our old traffic light system, this would have actually been a false warning for us, and we would have actually missed out on some of the recovery time frame, because the way the traffic lights work, it's looking for big long-term trends, not day-to-day or week-to-week trends. In this scenario, having just bought and held, even going through that full 17% drawdown, you'd have been better off because you'd only taken 4 months to recover, which is not a long time in the grand scheme of things. And we should have, if you're spending your money in retirement, we should have anywhere from 3 to 4 or 5 years worth of your spending capital for retirement in short-term bonds or medium-term bonds, some type of low-risk bucket that's not going to be subject to this kind of market volatility. So Let's move forward to May of 2011 to September of 2011. We're going to dive into this one a little deeper after we're through the charts, so I'm not going to spend a lot of time on it. But this was a 22% drop in just 5 months, and it took 5 months to recover. The next one was April 2012 to July 2012. Over 3 months, we lost 11%, not as big of a drawdown, and it only took 3 months to recover. Then in 2015, we had a really sweet ride from basically 2012 through the end of 2015. It was fairly smooth sailing, only a few months worth of losses. Most months were green during that time frame, as you can see here. It was just a really nice couple of years, very low volatility. But when it hit, from 2015 to 2016, we had over a 15% loss over 8 months. We actually had 2 dips during that time frame. You can see them here. We lost from July through October, and then we recovered. But then in December and January, we lost more money. But by February, we were recovering. And then February was its worst month. And then we recovered within 5 months of hitting the end of that drawdown. And so next up, we have the January, this last year, beginning of the year, at the end of January through the beginning of March, had over a 12% loss in the market over that 3-month time frame, and it took us 5 months to recover. Now, where are we today? Today, October 18 to just before Christmas, December 20th, we're looking at a total of 17% in losses so far from October, and our recovery is pending. But what I want you to understand, and this is so important, you've got to see this in context. The environment that we're in today is not this environment. It's not the 2008 correction. It's not that recessionary time frame. We are not in a recession yet, folks. We're still at least a year or 2 away from that happening. And so this market environment we're in now, where we're down 17% from where we were in September, I know it's painful. Trust me, I'm losing sleep over it at night too, because I'm seeing our clients who are relying on us to make good decisions for them. I'm seeing their account values drop, and 17% is a big drop. I get that. I understand it. I feel that pain too. I feel it in my own account, and I want you to know the right thing to do is to be holding through this drawdown, because it should be short-lived. Now, I can't say that I can guarantee that. I won't say that I guarantee that. But if the pattern follows the way that it should, we should expect to recover over the next 4 to 6 months, as long as we hit the end of this drawdown over the next month or 2, which we'll talk about in another video. I won't have time to do it today. So quick recap on all of them. This is all those small corrections that I just went through, as well as the 2 recessions at the beginning. You can see kind of how the chart looks. We've got 2 really big drawdowns here for the recession time frames, and those took a long time to develop, and they took a long time to recover. But everything else, these little bumps in the road, even though they don't feel little, because a 15 or 20% move is not a little move, but the recovery time is just so much shorter, and that's the important thing. That's what I believe we're in today, and I expect that we're going to continue to go through this pain that we're in right now. We're going to work our details out, but come January and February, we're going to start to see I believe we're going to start to see some of these issues that we're facing today, like I talked about in our last video. I believe we're going to start to see those begin to work themselves out, because they have deadlines to do so. So key takeaways from the video today: we're not in a recession yet, so please understand that the drawdown and recovery should be short-term, and likely within 4 to 6 months we could be in a position that we begin to see our stock market back to where we were in September. That's what I expect to see. Again, I can't promise that that is going to be the way that it is, but that's where I'm expecting us to be, just based on historical evidence that I went through today. Next up, following the traffic lights could cause us to miss out on an early upside rebound when it does happen. So we're holding the course. That's why you haven't seen a lot of trades in your portfolio. So we really believe strongly in this market and the recovery that is going to come. And last thing is that you should consider this as a buying opportunity. This is a time to be rebalancing your portfolios in your 401k plans. If you want some help doing that, or you'd like some insight or some pointers, feel free to give our office a call, talk to myself or one of our other advisors. We'd be really happy to help you do that, or at least talk to you about what that means for you in your overall plan and investments. So with that, I'm going to sign off for today. I hope that was helpful. Thanks so much for being here with us today. Looking forward to chatting with you again soon. By the way, feel free to give me some feedback. Send me an email. I had one client this last week tell me he wanted me to play the guitar and write a song or something so that we can start this off with a little more exciting note than what's going on in the market right now. So if you'd like to see something like that, let me know. Thanks a lot. Have a Merry Christmas, everybody, and a happy holidays. I hope you enjoy time with your family or loved and do the things that are more important than worrying about your money right now. So take care. We'll see you later. Thanks.